Welcome to The Critique. Today we're looking at a collection of Q2 FY26 previews and strategic thoughts on the Indian cement sector.
Right, it's a solid compilation, pulls together views from several research houses. A good starting point. Let's dive right in and see how we can make this analysis even sharper.
Okay, so first off, I think that the consensus on Q2 is pretty clear, right? Everyone expects strong year-on-year EBITDA growth.
Yeah, that low base from Q2 FY25 makes it almost a given. That part's straightforward.
But then, looking ahead, that's where it seems to diverge quite a bit. You've got Axis Securities suggesting prices might, quote, remain firm because of the shift to value-driven growth. But then ICICI Securities is forecasting more of a flattish price trend for Q3, maybe Q4, with a real margin recovery only kicking in from FY27.
Exactly. And that divergence, that's crucial. The problem is, the analysis highlights these different views on pricing timelines really well, but it doesn't actually build a usable framework for the reader to navigate them.
I see what you mean. It lays out two kind of conflicting scenarios. Is the issue that it doesn't pick a side, or is it something else? Like, what's the specific weakness?
Well, it's not about picking a side necessarily. The weakness is that it presents these views, H2 FY26 recovery versus waiting till FY27, without really digging into why they differ or which assumptions might be more robust.
Ah, okay.
So, is that strategic shift Axis talks about, the value-driven growth, is that really strong enough to counter the immediate supply pressures and slower volume growth that ICICI and others are pointing to? The document doesn't help the reader reconcile that.
Right. It leaves you kind of stuck between two forecasts. So the suggestion isn't to declare one right and one wrong, but more to, synthesize them somehow?
Precisely. The suggestion is to dedicate a specific section to building, let's call it a risk-adjusted consensus view on pricing.
Okay.
This means you actually need to model it out. Build a scenario analysis. When are these new capacities really going to bite? When does that aggressive pricing, like we saw in the South, potentially peak? And then weigh that against when this value strategy might realistically gain traction.
Got it. So instead of just listing quotes one after another.
Yeah, don't just list them. Group the reports. Maybe think about their underlying assumptions about competition. A concrete way to do this, you could build a matrix, maybe.
Like comparing the timelines, H2 FY26 versus FY27.
Exactly. Compare those timelines against key variables. Impact of new capacity, effectiveness of value strategies, that kind of thing.
That would force a clearer picture, wouldn't it? Show the potential risks and rewards of each scenario side by side?
It gives the reader a much stronger framework for their own decision-making, rather than just presenting contradictory quotes.
Okay, that makes a lot of sense for structuring the supply side and the competitive outlook. But pricing depends on demand too, right? So let's pivot. The material does make a pretty strong case for sustained demand in the second half.
It does. It highlights government capex, potential GST cuts for affordable housing, good growth drivers in the East and Northeast. That narrative is definitely there.
But, I sense a but coming.
Well, yeah. There's this other piece of data, a critical counterpoint, that feels almost buried. It's presented like an aside, but it potentially undermines the whole demand story.
You're talking about the project awards date, aren't you? It does mention that actual awards are down, 37% year-on-year to 1.2 trillion rupees?
Right, which is way below the recent average of 1.5 to 2 trillion. That's not just a small dip.
Okay, so the weakness here is...
The analysis needs to isolate this finding and rigorously stress test the entire infrastructure demand thesis against this quantified drop in actual project awards.
I see it now. It presents the bullish case based on tender announcements, but then this huge discrepancy with actual awards isn't properly reconciled with the overall 7-8% volume growth forecast.
Exactly. It's like they buried the lead on the infrastructure risk. High announcements are great, but if projects aren't actually getting awarded and started,
then that non-trade demand, which is crucial for H2, could really weaken towards the end of the fiscal year.
Precisely. So if that 37% decline in awards continues, relying so heavily on infrastructure spending for H2 volumes becomes much riskier. The suggestion, therefore, is immediate. Isolate this finding.
Don't just mention it, put it front and center.
Yes, and create a proper stress test scenario for the demand forecast. You need to quantify how much of that expected, say, 8-9% H2 volume growth is actually vulnerable if non-trade demand slumps, because projects are delayed.
Okay, so really quantify the risk. How could they present that clearly? What's a concrete example?
Well, a sensitivity table would be perfect for this. Show H2 volume growth under different scenarios. Scenario A, awards bounce back to the RS 2 trillion average. Scenario B, awards stay low at RS 1.2 trillion.
Ah, I see. That would make the significance of the awards data crystal clear.
Absolutely. It provides actionable context for the risk, moving it from a footnote to a core part of the analysis. It makes the whole piece much more predictive.
That focus on execution, not just announcements, is key. Okay, let's switch gears one last time. Let's talk capacity utilization rates, CUR. This part confused me a bit.
How so?
Well, it highlights Star Cement hitting, 90% utilization at a new unit. That sounds great, right? Operational success?
Sure. As a ramp-up story, that's impressive.
But then, in almost the same breath, it mentions really low aggregate CURs for major players. Damya Bharat at 52%, Shree Cement at 54%. How do those two things fit together?
They don't really in the way it's presented, and that's the issue. The core weakness here is that the material treats capacity utilization rate inconsistently. It's confusing a specific operational win with a broader market pressure indicator.
Okay, explain that a bit more.
It focuses on the successful ramp-up efficiency, the individual tree. Star Cement's 90%, but it fails to connect the dots to the forest.
The forest being?
The forest being the really low aggregate CURs for major players like Dalmia and Shree, and what that implies for the whole market, especially given the projected pan-India CUR of only around 72% medium term.
Ah, so the positive micro story is kind of masking a worrying macro trend. That 52% utilization for a big player isn't just their problem. It creates pricing pressure for everyone.
Exactly. That lack of a unified narrative is the failure. It obscures how those low individual CURs, 52%, 54%, directly fuel price competition in those specific regions. If you've got nearly half your capacity sitting idle, you're almost forced to chase volume, potentially at lower prices, right?
Right, just to keep the plants running and maintain share. Okay, so the suggestion has to be about separating these concepts.
Absolutely. The analysis needs to structurally separate greenfield, brownfield ramp-up efficiency, that's where Star Cement's 90% fits, from aggregate capacity utilization and competitive pressure. Make a sharp distinction.
So the reader understands that one doesn't negate the other.
Correct. That separation prevents the positive efficiency story from hiding the underlying structural oversupply in certain areas. And crucially, it allows you to link low aggregate CURs directly to the regional pricing weakness we already discussed, like that RS 10-12 drop per bag in the South.
Okay, makes sense. How could they show that distinction clearly in the report? A concrete example.
One effective way is to structure the CUR discussion geographically. Analyze the CURs in the South and East for players like Damia or Ambuja.
And explicitly link those low numbers.
Explicitly link them to the need for aggressive marketing or potentially lower margins. You could even tie it to Damia's perhaps softer volume growth outlook, for instance.
And then contrast that?
Then sharply contrast that with a market like the Northeast, where Star Cement operates. Highlight their high efficiency, yes, but also explain the regional dynamics, maybe fewer players, logistical barriers that protect them somewhat from the broader pressure seen elsewhere.
So it becomes a regional story, linking utilization directly to pricing risk in each specific market.
Exactly. That gives a much clearer segmented view of risk based on actual capacity levels on the ground.
Okay, this has been really helpful. These critiques seem highly targeted at making what's already a strong, data-rich piece even more insightful.
I agree. The foundation is solid. It's now about refining the synthesis, structuring the analysis to really help the reader anticipate risks and manage expectations.
So just to quickly recap the three main actionable suggestions. First, tackle that conflicting pricing timeline.
build a scenario matrix to create a more risk-adjusted view of future competitive behavior.
Right. Second, elevate the project awards data. Don't just mention the decline. Use it to rigorously stress test the infrastructure demand thesis with a sensitivity table showing potential volume impacts.
And finally, clarify the capacity utilization story. Create a clear structural separation between individual plant ramp-up efficiency and the broader market pressure from low aggregate utilization, using regional analysis to link CUR directly to pricing dynamics.
Implement those changes, and this analysis moves from being a comprehensive compilation to truly definitive strategic guidance. We absolutely encourage you to incorporate these structural and analytical shifts, and feel free to submit the revised work for another look.